Okay, 7:02. We'll go ahead and get started this evening. First of all, I want to say I appreciate you all being here. For those here live, certainly know that there's other things you could be doing with your time, so appreciate that. For everybody watching a recording of this later, again, appreciate that and appreciate you taking the time to educate yourself. I'm Clint Harris with Nomad Capital. We're a self-storage syndication out of Wilmington, North Carolina. Specifically this evening, we're going to talk about self-storage from an educational standpoint. I never want to look at things as like we're trying to sell you as why self-storage should be a part of your portfolio or why the Nomad deals are something that you should look at. We'll talk a little bit about that at the end, but specifically want to focus on self-storage, the different options that you have from an investor or developer standpoint, and some of the changes that we're seeing in the industry that are really having a big effect on what self-storage needs to look like moving forward. So we're going to look at that together. Here we go. All right, so the discussion about what we're going to talk about this evening, let me move this out of the way here. We're going to talk about why self-storage. We'll talk a little bit about our background and what gives us the right to talk about this, some of our track record, and some of the things that make self-storage a great asset class. We'll also walk through some of the projects that we have done because they're great examples of the different types of storage that there are, a little bit about our background and the types of projects we're working on now. And then eventually we will get to the current offering that we have, and we'll go through some of those details. All right, so why self-storage in general? It is a great asset class. It's the top performing commercial real estate asset class of the last 30 years. In terms of consumption, 11.1% of all U.S. households are currently using self-storage. That does not include businesses. So that's 11.1% of current just under 15 million households. The national average occupancy is 87%. There's been some fluctuation over the last year or two that, obviously with COVID, a ton of people that were needing all of a sudden have office space at their home, so they're moving things out. And then obviously now we have the housing market, which is effectively frozen. So there's been some ups and downs, but overall it's stabilizing. As of right now, national occupancy is 87%. It's a $54 billion industry. It's the fastest growing commercial real estate industry out there. There are 51,000 nationwide facilities out there. It's still a very fragmented market with 70 to 75% of those facilities still being mom and pop owned, although it is quickly consolidating. So this is the industry overview of the performance of self-storage basically over the last 30 years. So if we specifically look at a down market, you see the column on the left here. This is the REIT performance from 2007 to 2009 when the market crashed. And effectively everything was down. Let me move this so you can see. So the S&P 500 was down 22%. Mortgages, 19.5%. Self-storage was down, but it was down 3.8% during that time frame, that 3-year period. Overall, from 1994 through 2021, when these stats came out, it's the top performing commercial real estate asset out there with a net gain of 18.8% year over year. On the right, this is a study put out by Marcus and Millichap, a big commercial real estate brokerage research firm. They came up with basically a chart showing what is the most and least inflation-resistant asset classes in the commercial real estate space. What they found is that self-storage is not the most inflation-resistant commercial asset, but it is next to it. The most inflation-resistant commercial real estate asset is actually hospitality. So if you think about a hotel or even a Airbnb or a short-term rental, they can change the rate on a night-to-night basis. So if inflation is creeping up quickly, like we saw over the last few years, they have the ability to change the rate from one night to the other. Self-storage is always month to month. So instead of being locked in a year or 2-year lease or potential 10-year triple net lease where the increases aren't keeping up with inflation, self-storage always has the ability to adapt on a month-to-month basis. So it makes it extremely inflation resistant. And as we know recently, recession resistant and pandemic resistant, honestly. So industry overview. This slide is a little bit anecdotal, but if you had made a $50,000 investment into self-storage in 1994, as of 2021, not adjusted for inflation, that would be worth $5.2 million. So it's a visual just of how much progress there's been with a year-over-year gain in that commercial asset class. So overall, This is a very sticky asset class. And what I mean by that is the average person thinks that they're going to be in a unit for 1 to 3 months. And what we find out is that almost 40% of users are in the unit for over a year. The number one drivers of like who is the consumer, obviously moving is the number one. With 42% of the people are moving from one house to another. And that doesn't include downsizing and moving from a larger house to a smaller, but just location moving, school districts, work, whatever it may be. So that's 42% of your consumers. 31% say that they don't have enough space at home. So they're creating more space for themselves. Again, that's something that we saw big during COVID, more people being location independent and can work from home. 7% are from downsizing. 7% are from changing household size, empty nesters, and things like that. And then you have 3% are storing for business. But of those consumers, most think they're only going to be in there for a few months. In just about all of our facilities, we have people that moved in from the first year that was open that are still in there. Almost 40% of tenants do end up staying for over a year. So there's four main drivers of self-storage. And we're going to talk a little bit about some of the generational changes that we're seeing and how that's pushing a drive in this direction as well. But traditionally speaking, they call it the 4Ds of self-storage. And it's death, divorce, downsizing, or displacement. So obviously, you have a death in the family, somebody's downsizing, you're emptying out a house, you have split families, people have empty nesters, children are moving out, or generational move outs. You're going to have downsizing in the house there, or displacement work. We're having a lot of people, especially West Coast, move to East Coast or to Texas and things like that. So that displacement is obviously a big driver of self-storage as well. But there are some changes outside of this that we haven't talked about yet. So this kind of comes around to the emerging trends of what we're seeing. So the trends have evolved, and they've evolved really quickly. And there's a few drivers behind this. The number one thing that we're seeing is generational differences. So my partners and I, when I started investing with my partners, we bought a Kmart in 2020 as a joint venture and converted an old Kmart building into self-storage. And my biggest concern was, when I think of self-storage, I think of baby boomers, and I think of Christmas decorations and old antique furniture. And my question for myself was, is this the dying asset class? So we dug in deep on the data, and what we saw then and what we're continuing to see is that the younger generation is consuming self-storage in a much different way. And I think it steers the direction in which self-storage developers need to be moving. What we're seeing is the older generation, the baby boomers, would be in the facility once or twice a year. It is the Christmas decorations, it's the bulky furniture and things like that. The younger generation, the millennials, are now the largest population segment in the country. They are 34% of the population. They utilize almost 38% of self-storage. But the way they're using it is different because the younger people, unfortunately, are not able to buy houses the way that the previous generation did for many, many reasons. Interest rates right now being one of those, but there's a lot of other reasons as well. Instead of purchasing, younger people tend to rent and rent for longer. Renters tend to use more storage than owners. So what we're seeing is the younger generation is renting. When you are renting, you rent based upon the size of the square footage that you get. So instead of renting a 2-bedroom condo for $1,800 a month, you're renting a 1-bedroom for $1,300 a month. And they will use a climate controlled self-storage unit as an extension of the closet. They still have winter clothes and they still have lifestyle items as well. And they will store those there because it's cheaper than paying for the extra bedroom space. I probably sound like a broken record to those of you on here that I've talked to before, because this is a trend that affects the way that we are developing out our self-storage in terms of entry and ease of access. We also have commercial tenants. So we have a lot of businesses that are downsizing or shuttering their brick and mortar stores. And so they're using storage as mini warehouses and honestly as mini distribution centers because they're still doing sales. They're moving more and more of those sales onto online platforms. They still have to be able to store things. And so they'll use it as a hyper-local distribution center. And then the younger generation is using it for the mountain bikes, the kayaks, the waders, the fishing rods. And because of that, they need to be able to get in at 6 a.m, grab their snowboard and their bibs and get out of town. So that access is important because that's where their winter clothes are. That's where their coat is. And that's one of the reasons that if you're doing self-storage these days, it needs to be several things. It needs to be safe, secure, well lit, easy access, and it needs to be climate controlled. And of course, as always, it needs to be fairly centrally located as well. So why is it a great long-term asset? So there's a reason that we chose this as an asset class that we wanted to hold for the very long term. One of the interesting things about storage compared to, say, multifamily apartment complexes, this is a little bit of an oversimplification, but on an apartment complex, of the gross potential rent coming in, typically 65 to 70% of that number is going to be expenses. You got office staff, security, landscaping, everything else that comes with it, pool maintenance, all of that. The other 35% is your net operating income. One of the reasons we love storage is that we are renting people a box of air. There's no kitchens, there's no bathrooms, nothing like that. So what we're paying for is the LED lights, the AC, the office staff, and a little bit of landscaping and cleanup, and that's pretty much it. So of the gross potential rental income, 30% is the typical expense ratio when we open up a new facility. Now, during that time period, we're doing marketing and we're doing promotions, and the first month free or $1 for your first 2 months or half off or whatever it may be. As that facility stabilizes, we typically are going to spend less on the marketing. So over time, that 30% expense ratio will shrink down to typically 21 to 24%. If you have an unmanned facility, the lowest facility that we operate operates at a 19% expense ratio. So over the long run, it only continues to get better and better. The ease of that management is also one of the reasons it's a great long-term asset. Again, you have tenants technically, but they're not living in the property, or at least they shouldn't be. You don't have kitchens, you don't have bathrooms. It's a box of air. You have AC and lights and very few other things. It's also the sticky asset class as we determined. So once people get in there, they tend to stay there. It's obviously inflation and recession resistant. So those rents can change on a month-to-month basis. You can change rents for different sections at different times and stabilize over the long run. So those are some of the reasons we really love it as a long-term asset class. All right, so there's 4 different self-storage strategies that we're seeing from developers. And the first is obvious. It's ground up development. Now, there's a lot of risk involved with this. There's a lot of money that's required up front. Obviously, the cost of construction is still fairly through the roof right now. And the cost of land is expensive as well. And the most expensive thing of the whole situation is time. It might be 3 to 4 years by the time you pick 5 to 7 acres. You go through the entitlement, the permitting, the engineering, actually break ground, and then build the facility out. So it typically is a fairly high risk. And part of that is because it takes a long time to get the project up off the ground, and it's ground up development. The second type is an expansion project. And we're going to go through examples of all of these. An expansion project is exactly what it sounds like. You're typically buying an existing facility, and sometimes you might be able to add on to that facility and increase it that way. Sometimes you might be able to build up. Typically, you're going to add on somewhere on the property. It's going to have room for you to add more units. And so it's typically that property is an existing self-storage facility. So you're going to be paying more for that. And then you have the opportunity to develop, which again takes time to go through that process. The third strategy, and we've done all of these, by the way, but the third strategy is the acquisition of existing facilities, basically what we call operational turnaround. And you can buy an existing facility. A lot of times it's a mom and pop facility that doesn't have a website. They haven't had a rent increase in 10 years. You're going to automate the systems, increase the rents, obviously. Sometimes there's opportunity to change it from non-climate to climate controlled, but you're looking for ways to buy it as is and then increase that net operating income. The fourth strategy, which is it's the strategy that we really love, and we're going to talk a little bit more about this than the others because there's a little bit more nuance there, is a conversion. And that's typically where instead of building self-storage or buying existing and either expanding it or operationally optimizing it, you're buying an old, nasty, vacant big box retail building like a Kmart, a grocery store, a warehouse, a textile mill, or something like that, and you're converting it into self-storage. Now, this gives a lot of opportunity for forced appreciation. You're buying it as one thing, you're converting it to a different asset class. When you convert it to a different asset class, it changes the formula by which the asset is valued. If you think about old vacant big box retail buildings, there used to be thousands of Kmarts in our country. They're all gone now. But there's a reason that community used to drive to that location to buy their home goods. It's typically centrally located with great residential density, great vehicle traffic count. All those people used to drive there to buy their home goods. And even though they don't do that anymore, it makes it a good location for those same people to return to the same building because of the proximity. So that's a little bit about conversions, and we're going to dive more into that. But here's some examples. And we wanted to use our examples because we know the numbers a little bit more. So these are some of the facilities that we've done from the beginning. This is the facility. My partner, Eric, built this facility from the ground up in 2006. And then he since doubled the size of it. So in 2023, 2024, they expanded it and basically built twice the size of storage around there. Took several years, took a long time to build, took several years to stabilize. So the year he built it was 2006, and it wasn't until 2009. Now, obviously, we were going through a recession at that time, but also it was a fairly small facility, 37,000 square feet. So takes a while to build, takes a long time to fill it up. So you have to have those interest reserves to carry that note. Since then, have doubled the size of the facility. The current value on this is 7.7 million. And a lot of that is because storage only gets better over time. So this one's full. It's been full for a long time. This is the one operating at 19% expense ratio. So this is an example of an expansion. If you peek right back here, this little building, which is also this one in this picture here, is an existing self-storage facility. It also came with a few acres next door where there was room to build this. So this is the building that my partners built from the ground up. While the other facility was open and full, it gave them the opportunity to build this out and then slowly start filling it up. It takes a long time. It's basically the same as ground up development. It just had another existing building right next door. But that's a great example of an expansion project. And we'll walk through the numbers a little bit in just in a second. But that's a good example of an expansion. This is a really interesting one. I would call this an operational turnaround, but there is a little bit of a conversion component on this. This facility was a self-storage facility. It was called Front Street Self-Storage. And my partner, Eric, bought this. It was not climate controlled. It was full, but it had those old high-pressure sodium lights. Remember the ones they used to turn on in the gym when you were a kid, and they would click real loud, and then it would take them several minutes to warm up and for the light to actually come on. Because of that, the owner of this facility left them on all the time. And so it was really, really hot inside because of that. We're in Wilmington, North Carolina. The sun is hot anyway, but then the high pressure sodium lights inside the building had a thing cooking in there. So Eric bought this, converted everything over to LED lights. Actually, Duke Energy came in and had a grant to take care of that, or they took care of 90% of the cost of that. And his electricity bill dropped, even with adding air conditioning units on the roof. By converting it to LED from those high pressure sodium lights, the electrical bill went from $4,000 a month to $1,000 a month. So this is an existing facility, but there is definitely a conversion component there by converting it to a climate controlled self-storage. And obviously that allows you to increase the rents as well, besides reducing the expenses, which is not typical with adding climate control. But in this situation, the previous electric bill was outrageous. So it worked out very well. This is a traditional conversion project. So this, my fat head is in the way here. Let me move this out of the way here. So this is an old Piggly Wiggly grocery store in Macon, Georgia. This building was listed for $1.6 million. It sat empty for years. It had a hole in the roof. It had homeless people living inside of it. We ended up buying the building for $850,000. We'll get to the numbers in a little bit. But this is a standalone, it's freestanding building, empty for years. And this is what it looks like converted to a Class A climate controlled self-storage facility. So this is a great example of a total asset class conversion. You're taking something that nobody wants there, including the town and the people around there. But if there's a grocery store there, there's a lot of people that used to drive there to get their groceries. And so there's still good residential density to drive there and use it as a self-storage facility. Obviously, we have to do the feasibility study to determine that nothing's really changed in that community, but that was the case with this building here. All right, so I want to go through specifically why that strategy that we just talked about is the one that really blows us away. It's the one we're really, really excited about. So over the last few years, we bought 2 Kmarts, 3 warehouses, 2 textile mills, a grocery store, that one in particular, and an old bottling facility, which is this one right here. This is the old Sundrop bottling facility in Gastonia, North Carolina, which we converted to climate controlled self-storage. We're buying buildings that nobody else wants. We want the nasty properties. You know, when you flip a house and you make a lot of money, it's not because you sold it or because you renovated it. It's because you bought it for dirt cheap when it was nasty and it smelled like dogs and cats and nobody else wanted it. That's how we look at our conversion projects. We want the dog and cat properties that nobody else wants. We can get those buildings for dirt cheap. So by the time we buy the building and do the renovation, on average across our portfolio for the cost of the building, the construction, the land, parking lot, everything, our average is just under $65 a square foot. Whereas if this group in the virtual chat room wanted to go build a self-storage from the ground up, that's going to cost us $110 to $120 a square foot, plus the cost of the land, and it's going to take 3 to 4 years. We can take an old building, we can convert the whole building for an average of $65 or less for the construction, the land, building, everything, and we can do it in an average of 12, sometimes 15 months, depending on the size of the property. So the speed to market is really important as well because time is money. So the reason the strategy works, like if conversions are so great, why isn't everybody doing it? Well, there's a lot of risk involved. These are complicated projects. The reason it works for us are these 3 reasons on the screen right here. It's vertical integration. We have an in-house acquisition team that's looking at 50 to 70 properties a week to get down to 2 to 3 that they're going to do underwriting on, to get down to maybe 1 or 2 that we're going to send a letter of intent on a month. And these are on market and a lot of off market properties as well, to really find those properties in a good location for less than $20 or $25 a square foot. We have in-house construction. Eric and Levi have 30 years of experience of commercial real estate construction. We're building these properties out at cost plus 12%. The thing that'll really kill you with these projects is that you are always going to run into issues. It's not about if, it's about when. If you're using a third-party builder, the change orders are what will kill you. It'll cost you 3 months here, 6 months there. You're reordering, and that's what will really kill you because that keeps you farther away from your stabilization date, and those interest reserves will eat you alive. So we have in-house construction, and then we also have in-house property management. We started property management in 2006 with Eric's very first property. So basically what that comes down to is we don't pay retail costs for the buildings, for the construction, or for the management. That's the reason it works, is we're able to control those risks. So here's a track record and some examples, and you'll see some of the margins here, and I think you'll understand the value of ground up versus expansion and some of the conversion projects. So first of all, the reason that we have the right to talk about this, we have over 500,000 net rentable square feet of self-storage under management. We do have a hybrid management system. We have in-person management. We do have 1 facility. We used to have 2. Now we have 1 facility that we do manage remotely from another facility across town in the same area. And like I said, self-storage management since 2006. So on the left, this is what I showed you, pre-ground up development. 2006, stabilized in 2009. All-in cost on this one, this has since been doubled, and that's factored into the cost too. All-in cost is $2.2 million. Current appraised value on that is $7.7, but it took years and a long time. Here's the expansion project that we talked about. This is the existing building. This is the expansion. On this one, purchase and expansion, $3.5 million. Stabilized value on this is $7.25. But again, takes quite a few years and a lot of heavy lifting involved. It's basically ground up construction. This one on the left here, this is a conversion of an old newspaper printing warehouse here in Wilmington, where I'm at. 24,000 net rentable square feet. This is a warehouse conversion in 2016. All-in cost on that was 1.7. Current valuation 5.5. That's because the cost of the building was dirt cheap. It had been on the market for a very long time. Nobody wanted it. There's very little appetite for big warehouse space, or especially big retail. 80 to 110,000 square feet. There's very little people operating in that space. City Storage South. This is the one that's managed remotely, by the way. City Storage North, because we have full-time management over here at City Storage South on the other side of town. This was the one that we talked about that was non-climate controlled and then was converted. So that's kind of an acquisition operational turnaround, but a little bit of a conversion factor there. This is a true conversion. This is an old Kmart building in Reidsville, North Carolina. This is a $3.6 million total project with an $8.8 million 5-year valuation. I want to point out this right here. We cut a hole in the front and the back. and we turned it into a climate controlled self-storage facility with a drive-through. You can actually drive straight through the building. In retrospect, I don't think we'll do that again. We thought everyone would love being able to drive right up to the units that they're renting. The reality is what rented first, we're still the farthest away units and then closer to the middle because people are still price conscious. They went for the cheapest units first. So a little bit of a lesson there. All right, this is a facility that we bought at certificate of occupancy in Holden Beach, North Carolina. So it looked like this. We bought it the day that it had certificate of occupancy. So it was completely empty. And the reason we bought it is because we are the GCs. And since then, we've added building E over here. So we got another building, and then we added exterior boxwell units as well to create another 40 units and maybe potential to add some more in the future. This one, $6.8 million project and $11 million valuation. So big swing, long time, but not quite as big of a, from an LTV standpoint, as some of our conversion projects. That's why we tend to like those a little bit more. This is a self-storage facility in Danville. And there's a lesson here with this one that I think is really important. So this is a 97,500 square foot facility in Danville, Virginia, an area that's having explosive growth. This facility is 1.5 miles from the new casino that's going in. It's a $550 million casino. They've been under construction on it for a couple of years now. So we bought this facility, and after we went under contract, we always look at the other storage in the area as well as the permit for what's coming down the pipeline. Well, after we were under contract with this building, we found out that U-Haul bought the 7 acres literally diagonally across the highway from this property for a new development. And so we thought about it. We're like, well, what do we do? That's obviously a big player. It was a little bit intimidating. And this is a while back, but ultimately we decided to move forward with the project, obviously. 12 months later, we were open. That's been about 15 months ago, and we're now cash flow positive. U-Haul has not broken ground yet. They're still going through the permitting process and then have to do engineering and everything else. I don't know that they will break ground. I'm sure that they probably will, but also keep in mind our cost basis on this is going to be less than half of what theirs is. We've never had to play the price game. And with this one, we won't have to, because by the time that they are opening, we're going to have long since been full and stabilized. So that speed to market is something else that's really, really important besides just the average price per square foot. All right, this is City Storage Macon. This is the building, the Piggly Wiggly grocery store. For those of you not from the Southeast, Piggly Wiggly is a grocery store chain, and not a name that I'm making up. So this is a 46, it's a 62,000 square foot building, 46,000 net rentable. The building had sat empty for years. There were roaches and rats inside of it, a hole in the roof from where a tornado had dropped an AC unit on the roof and punched a hole in it. There was a group of homeless people living inside. It had sat on the market for years. We bought the building for $850,000. We put a little over $3 million into it. So we're into the whole project for just under $4 million. And a 5-year stabilized value on this based upon the rents in that market is just over $13 million. So huge value swing on that one. And this is City Storage Gastonia. This is the old Sundrop bottling facility I told you about. This is the main road that runs through Gastonia, which is about 15 miles outside of Charlotte. And this road, the bottom right corner, continues and runs straight into the Charlotte International Airport. So huge visibility, great traffic count. The 70,000 square foot facility. It's got 9 different roof lines. It was very complicated. Our construction team did an amazing job on this property. It looks incredible on the inside. This is a $5.1 million project with a $14 million 5-year valuation. So why is that important? Obviously, yeah, that's a lot of money, but it's just a lot of money on paper. Well, we're going to get to that. Look at this building. This one's in Burlington, North Carolina. This facility just opened a week ago. 65,000 square feet, 45,000 net rentable. This is an old hosiery and textile factory right across the street from downtown that we converted. $5 million project, $13.4 million valuation. The reason that's important to us is because on average, when we stabilize one of our conversions versus the other strategies, we're landing at 35 to 38% loan to value, which means not only is the property very safe, it also means we don't have to liquidate the asset to give our investors a payday. We can refinance, and we'll refinance to 55, maybe 60% loan to value. We want to make sure we're protecting the asset and that we're not stressing it. And by the way, when we refinance, we only ever use fixed rate debt. We've never used variable rate debt. We never will. So when the initial purchase, we either purchase it with cash for the fund or we use fixed rate debt. When we refinance, also always fixed rate debt to make sure we're protecting the asset. When that happens, it means we're able to pay our investors out by way of a refinance, which is non-taxable because it's not a capital gain. So that's part of the strategy that we really like. A little bit about who we are. And I want to tell you the reason why we're called Nomad Capital. So these are my partners and the founders of Nomad Capital, father and son team of Eric and Levi Hemingway. So I think you'll remember that facility in Kachina, Arizona was Eric's first property. He built that in 2006. Well, the market crashed in 2008, and Eric built this right in the middle of an area that was supposed to have this massive boom of residential real estate coming to the area, and everything ground to a halt. So the long story short is Eric and his wife Rachel and their 5 kids bought a sailboat in Greece, sight unseen. That sailboat right there in the photo, 36-foot catamaran. With their 5 kids, they flew over and they started sailing. 6 months into the trip, found out they were pregnant, kept sailing, had their 6th child in Jerusalem, ended up sailing for a total of 3.5 years, sailed back across the Atlantic, and eventually ended up back in Wilmington and back to development. That time period is what led to the idea for Nomad. The idea that you can have a nomadic lifestyle with your family or the people you care about because it's supported by a portfolio of real estate, meaning that you get to go where you want, when you want, and do what you want. That time, location, and financial independence creates an independence of purpose. That's kind of the core values that we try to live by behind Nomad. It's the reason behind the name. And it's the reason we chose self-storage, because it's a very good asset class for a long-term hold. And that's our preferred strategy. This is the leadership team, Eric and Levi Hemingway here. Drake is our acquisitions manager. Myself and my partner, Neil Henderson, who's also on this call, we handle investor relations and capital raising and honestly, investor education. That's what we try to focus on. 40 years of commercial and residential construction experience, 30 of that in self-storage. We're currently sitting on $150 million of assets under management, and we haven't sold anything. I know that there's going to be properties that we sell along the way as we trim the portfolio, but our preferred strategy is a long-term hold. And as it sits right now, we're sitting on all of those assets that we talked about, and we haven't sold any of them. So this is the full team. We have 4 general partners and then 16 employees now, and then property managers as well. So that's a good look at who you're likely talking to when you call in and on the phone with one of the different departments. All right. We briefly are going to talk about our fund offering and what we have going on, and then we'll kind of get to the point of answering questions and making sure I answer anything that you want to know about self-storage. So all the previous properties that we talked about, we did as individual deals. This time around, we're doing a fund. So we're about 6 to 8 months into it, at least. We're raising $10 million for the purchase of $30 million worth of projects, which should be converted to around $70 to $80 million worth of self-storage facilities. We've already closed on the first 2 properties in the fund, and we have 2 more under contract, which I'll get to in just a little bit. But these are all big box retail and mill conversions across the Southeast. We operate in North and South Carolina, Georgia, Tennessee, and Virginia. This is the targeted 19 to 22% IRR. All of these are being converted to climate-controlled storage, and this is a 10-year fund, but there's a cash-out refinance at 5 years with a return of initial capital plus another event as well. I can get into more details about that if anybody feels like contacting and talking about it, but I want to tell you about the project. So this project is in Kernersville, North Carolina, booming little downtown area. I think you'll notice we love the secondary and tertiary markets. You're not going to find us in a downtown Charlotte. We're kind of priced out of that area, but you will find us 15 miles away in a Gastonia, where there's this massive population shift where people are getting pushed out of the more expensive urban areas into these small secondary and tertiary markets. So there's a massive boom of people moving into the area. It's already underserved for storage, and now you've got multifamily properties coming to town left and right. So our model is we want to move right into that town, pick up a big building like this. It's a 92,000 square foot mill conversion right in the middle of downtown. The feasibility study on this shows a 24-month lease up. It's a $12 million valuation after year 3. The existing self-storage in the area has very high rents and very limited availability. So we're going to get this converted quickly. The unique thing about this is this valuation does not include this area up front. This is a 15,000 square foot antique mall, currently paying $10,000 a month in rent. And eventually, after we stabilize the rest of the property, we will circle back. We're going to relocate those tenants and convert that to additional units as well. Just a couple more slides here and we'll be done. This is property 2. Again, these properties have already been closed on and are under construction. This is actually a sale leaseback. There's a company called Bull City Cider Works. Their flagship is out of Lexington, North Carolina. This is the brewery and attached to this big warehouse. So we bought the whole thing, and then they leased this portion back for $17,500 a month on a 10-year lease. That's their flagship location of, I believe, 5 locations, maybe 6. So this is a 26,000 square foot warehouse that we're converting. It's nice to have that additional cash flow. Very underserved market. There's only one other climate controlled storage in the area. Lexington is having a massive revitalization program right now. Huge growth there. This has got a $5.1 million valuation just as the storage, 8.6 including the brewery and the entire property. So those are the 2 that we're already under construction with now. This Lexington property is scheduled to open in September. So we're recording this now in July. All right, these are the 3rd and 4th properties in the fund. This is probably news to a lot of you to get a chance to see these for the first time. City Storage Flowery Branch. This is Flowery Branch, Georgia. 85,000 square feet, 55,000 net rentable. This is a suburb of Atlanta, just north of Atlanta, near Lake Lanier. Very strong demographics. The 3-mile radius here is 25,000 people. Median household income is 82,000. So very nice area. Still strong growth in the area. It's 2 miles away from major retail, Target, Home Depot, Kohl's, Chick-fil-A. We always say if you can smell a McDonald's or a Chick-fil-A, you're in the right spot. You're going to do well. So that one is under contract right now. We're wrapping up the fundraising for this fund to get that property closed in about 2 months, I believe. And this is property number 4. City Storage Florence, South Carolina. I'm from Lexington, South Carolina. Excited to finally have a project from my home state. This is 25 to 30,000 net rentable, generating roughly 275 storage units. Conveniently located near the Lowe's, the food line, the Walgreens. Hospital is within a mile. High traffic count, 20,000 vehicles a day. Very low competition in the area. This one's really unique because there's a large section of this building that has enough height that we could add a mezzanine, create a second floor, and put an elevator in, which we've done in the past. So it gives an opportunity. Right now, we're working with the acquisition team, the engineering, and the construction team to kind of work this out and say, is the juice worth the squeeze? First of all, does the feasibility study that the area can sustain this much storage? If so, what's the additional construction cost? What's the engineering look like? The reality is with this current fund, the options are either use these 4 properties and put on a second floor and we're done with this fund. We're closing it out over the next few months and we're wrapping it up. There is an option that this property works great as a single level. So we could do this as a single level. And if so, there's potential opportunity to add a 5th property onto this fund that we just had an accepted letter of intent on. So I'm not going to get into that. We don't have a signed PSA on that one yet, but we've got a couple opportunities right now. This fund could be closing out very quickly. Either way, we'll wrap the raise up fairly quickly, but it's either going to be 4 properties with this one being a lot larger than we originally anticipated, or a potential 5th. So that's what we have coming down the pipeline with the current offering. I think that's it for now. If you want to contact me or my partner, Neil, he's also on the call. These are our numbers. Feel free to reach out. You can scan this QR code as well and have an opportunity to connect with us. And that's it. I'll leave it here. Let me get over here and make sure, give everybody a chance to, I'm going to stop sharing my screen for now. So if you want to go ahead and scan that if you'd like to, I'm going to get back over here. And give me just a moment. Okay, I've got, do you get a recording of the video? Yes, sir. If you signed in, you certainly should. We will send that out, I believe, tomorrow. I believe we're going to do some editing on that as well. So yes, sir, you certainly will. Any other questions? I think the best way to do it now is if you want to type your questions in, we can answer those one at a time. So thanks for that question, Paul. or you can raise your hand and I can call on you. Let me see my participants here. All right. Neil, you are unmuted. Grace, can you hear me? I saw you had your hand raised there.
Yes, I can hear you.
Great. Hey, Grace, nice to connect with you again. Glad you're here.
Hey, Clint. I met you at the Best Ever at Salt
Yeah,
Lake
I
City.
remember.
Thank
I
you.
remember. It's great to see you again.
Nice to see
Yeah,
you.
what's your question?
My question is about the distribution to the investors of the fund.
Hmm.
How do you distribute to the investors?
Yeah, great question. So you have to keep in mind that these are development deals. So the way that it operates with us, from the day that our investors' capital goes in, they start earning a preferred return. That preferred return, it varies depending on class of share. And I can share that information later. We have class A, class Bs, and a class A plus share. So from the day that your capital goes in, it starts earning a preferred return. But remember, we're buying these old buildings. There's no cash flow. So typically it's going to take us 12, sometimes 15 months to build out a property. After that, the property is worth way more than when we started, but it's empty. So now we have to fill it up, and that could take 12, 15, 18 months, depending on the size of the property. As soon as it becomes cash flow positive, all of that money goes straight back to the investors to catch them up on that back owed preferred return. The reality is we could pay our preferred returns from the very beginning, but we all know what we would really be doing is be borrowing more money from our investors than we really need and paying them back with their own capital. So it takes a year to build it out, at least a year to fill it up to the point of being cash flow positive. By the way, our cash flow positive is around 40% occupancy. Most self-storage is between 60 to 65, but because of the low cost basis, our occupancy break-even point is typically around 40%. All of the money then goes back to catch our investors up. So typically end of year 2, beginning of year 3, you have the preferred return from the first 2 years, and then cash flow year 3, cash flow year 4, cash flow year 5 at or before year 5. If the market's good, it might happen a little early. Cash out refinance on the property. Everybody gets a return of their initial capital plus another lump sum. That lump sum coming by way of refinance is non-taxable. And after that, it's a long-term hold. And I'll walk through the nuance a little bit, with each person to make sure they understand it if they have questions about that. But preferred return plus cash flow, that portion is obviously taxable. The return of capital and then the chunk on top coming by way of refinance is obviously non-taxable because it's not a capital gain. The taxable income, we do the cost segregation study. We take the accelerated depreciation with the goal of giving every investor K1 to offset that. Our overall goal is to try to do the best we can to double everybody's money in 5 years or less. From there, the long-term hold, additional cash flow, year 6 or 10. In this fund, we have another event at year 10. There's a couple different ways we can go about that. After that, even we have to put an end date on this fund so that I can tell you the return. It's a 19 to 22% IRR, 3.2 to 3.6x equity multiplier. But after that, our intent is we're going to continue to hold properties. Beyond that, it just turns into an unlimited return because as long as the fund owns properties, everybody stays in the fund. You continue to hold it long term, and you get quarterly cash flow distributions. That was a lot. I'm sorry. I'm happy to
Yeah,
talk to you
thank
about it
you.
more in person if you want to connect. Did
Yeah,
that answer your
thank you.
question? Yeah.
Yes, that did.
Great. Thanks, Grace. Appreciate you being here. Let me see. Scroll down. I don't see any other raised hands. Let me check the comments. All right, we got several in the Q&A here. Yes, you do get a recording. Can we go over return payout schedule? Also, any depreciation benefits? Yes, Eric, I'm happy to do that. And I'll send out the information on that for the return. Again, I'll be the first one to tell you. If you're looking for immediate cash flow, monthly distribution starting from day one, you're trying to replace an income from a job that you don't like or anything like that, or if you think that you might need your cash back from your initial investment in 3 to 4 years, my recommendation is that we are probably not the operator for you. These are development deals. We get this massive appreciation because we do the development. It takes a while to build it out and a while to fill it up. So if that's what you're looking for, it's more of short-term returns. My recommendation is that we're probably not right for you. But I'll send out the information that has the return and the payment schedule. And the typical depreciation benefits, it varies wildly from building to building. But typically on the conservative side, we're in the 25 to 35% depreciation range. We've had as high as a little over 45%. But typically, I feel comfortable saying that 25 to 35 depreciation range. All right, Robert, let's see. Yeah. So return on investment year one, year two, you have an accruing preferred return. So it's building year one, year two, end of year two, beginning of year three is when that depreciation comes out. So the K1 for this fund, you should get one K1 for this year. It'll be a small one. And then should be 3 more properties coming online. So you get a larger K1 showing your depreciation next year as well. We have to open up the property and get the CO before we can take the accelerated depreciation. All right, Brett, worst case scenario, the fund runs into financial issues. Do investors own portions of the physical real estate that could be sold to recoup capital? Yes. So everyone in the fund is owner of the land, the building, all of it. And along with that, anything additional that we come up with. So that antique mall, 15,000 square feet being converted to climate controlled storage, that's additional. That's not part of the return profile. The income coming in off of the brewery at Bull City Cider Works. Again, you're part owner of that as well. On the facilities where we're able to add boat and RV storage and fence in a parking lot, you're part owner of that. If we're able to put in solar on the rooftop later, you would be part owner of that. Again, those are all just additional things. But yes, we're opening up these properties at stabilization. We're typically sitting around 35 to 38% loan to value. We're never going to refinance over 55 to 60%. So we don't stress that asset. We want to make sure that our job is to protect the asset first and make sure that it doesn't have issues, protect the investors second, and then protect ourselves third in that order. But yes, you are owners of the physical real estate, not just the business. John's got a great question. How competitive is the space? I've received several pitches lately. Well, the number one competitors to storage is more storage. That's the reason I think our business model is important. Our model is we move into an underserved market. We have a facility open in 12 to 15 months, and we do it for half the cost of new construction. If we move into a new market, we pick up 80 to 90,000 square feet and we convert it in a year. It's very hard for other people to move into that space. We have a competitive advantage in terms of cost. We definitely have competition in the space. You know what matters with self-storage? About a 7-mile radius. That's about as far as people are willing to drive for storage. So I'm not really concerned with what's happening nationwide. Obviously, we're paying attention to it. But what matters to me is what's happening in the microeconomy of that town. What's the residential density in a 1, 3, 5, 7-mile radius? What's the amount of people in the area? Is that population rising or falling? Percentage of renters versus owners, number of people per household, median income. Make sure not too many people work for one business that could shut down and drive people out of town. So it is competitive, but it's the microeconomy that really matters. And that's why I like our model of doing it for half price and in less than half the time. Eric has a question about the preferred return. So it's a $50,000 minimum, comes with a 6% preferred return. From there, it goes up in $1,000 increments. So people will invest 75 or 128 or whatever. We adjust the equity. The next step up is a $250,000 Class A share. That comes with an 8% preferred return. And then we have $1 million share with an 8% preferred return with a 5% equity bonus. So when someone cuts us a check for $1 million, we put $50,000 of the GP equity on top, and that multiplies through the deal, just like if they put it in themselves with that 19 to 22% IRR, 3.2 to 3.6x equity multiplier. Eric's got another question. How much anticipated depreciation? As I mentioned, 25 to 35% depends wildly on the building. If there's an existing tenant in there, we get to take a little bit more depreciation. Storage does very well from that standpoint in terms of all the fixtures, the doors, the screws, the panels. K1s get sent out in March. We try to get them early every year. There's a struggle every year. We're required to have them out by March. That's something that's one of the few things that we don't do in-house. CPA has to handle that. The K1s are sent out by March. Jeff has a question. What's the percentage of ownership being offered in the raise? What's the development fee for the percentage of equity taken for setup? Great question. So the fee structure it's a 3% acquisition fee. Anytime we take down a property, the cost of the building, the construction, 3% of that comes back to Nomad. That goes to pay the salaries of the 16 people that you saw on the team slide. Excuse me. And then we have a 1% disposition fee. So anytime there's a sale or a refinance, 1% of that amount comes back to Nomad as well. Some of the things we didn't do on this, which we probably should have done, is we're not charging a fund management fee and we're not charging a marketing fee in this fund. This is our first fund. I think those are some things that we would change in the future, but that's it. The actual percentage of ownership on this is to be determined. And the reason is We have 2 properties closed. We have 2 properties under contract. It depends on if it's going to stay those 4 properties, if we're going to put the mezzanine into the Florence property, or if we're going to add on the 5th property that we have a letter of intent accepted on. So I would say you have to get with me again on that. It's going to take us a little while to calculate between the acquisition team, the engineering team, the development team, and everything else to find out exactly what's the highest and best use of the properties that we have either under contract or with a letter of intent. That's going to determine what that final ownership equity split is. So the preferred accrued return, how do you get paid? Again, that's back owed. The capital comes in, all of the money coming in goes straight back to the investors first until they're caught up on that preferred return, and then cash flow moving forward. I've got an anonymous, mysterious attendee. How are you able to build for so much cheaper than competitors? We build at cost plus 12%. So our construction team is those 3 components that I showed you. You got Nomad Capital as the syndicator. Founders are Eric and Levi Hemingway. Elm Builders is our builder. Elm stands for Eric, Levi, and Maggie, Eric's daughter. We only build on Nomad projects. This is all we do. We're not building outside of this. We operate under the brand name of City Storage for our management. We only manage our properties. We're not managing anybody else's. It's full vertical integration. So this is all we do. A lot of the reason we can do it for cheap is because anytime there's a change order or something changes, we can spin on a dime. We're not doing other projects. This is all we're focused on. So on average, we're buying the buildings for no more than $25 a square foot. A lot of times, $20 to $25 a square. We got one as low as $9 a square foot. And then we're typically putting $40 to $45 a square foot into the building. So our average across the portfolio so far is around $64.80 per square foot for the acquisition, the land, the development, the construction as well. And we're building at cost plus 12%. Most of the time, we're doing most of the projects ourselves, but we do counsel with other people. We have subs for things like elevators and things that we can't do. And if we ever find somebody that can do a component cheaper than we can, we're happy to do that. Our job is not to make money on construction. It's to land at a really low LTV. We want to land at that 35 to 38% loan to value so that we can pay everybody out by way of refinance, which means we get to keep the asset. Otherwise, if we're 60, 70% loan to value, when it's all said and done, we have no other option but to liquidate the asset. These are golden geese in our mind. We're going through all the trouble to build these out. The last thing we want to do is kill and eat the golden goose when we can keep living off the eggs. So for us, it all comes down to landing at that low LTV so that we can pay the investors out, keep the asset, and allow it to continue to cash flow long term, because that's what's going to make real estate nomad. Otherwise, we're building assets up. No offense to anybody else's strategy, but if we're buying C or B level apartment complexes, we're adding granite, stainless steel, we're increase the rent a little bit. Even though the value goes up 30%, you have to liquidate to get a payday. And at the end of the day, you're a glorified house flipper. Our job is to break away from trading time for money. The way that we do that is land at a low enough LTV that we can keep it. Oh man, we got a couple more here. Great. Does Nomad take advantage of any government programs, LED lighting, energy saving, HVAC? Yes. Yes, but it's very location dependent. We've also done 2 qualified opportunity zone projects in the past. So money that went into that as capital gains has potential to come out tax-free. We've done LED lighting before, but that was on personally owned projects that were done before Nomad started. We're always looking at that, especially for HVAC, and we're keeping a close eye on what opportunities are there for solar in the future. Obviously, anything that we do, everyone's owner of the property, so we would all benefit from that together. Have you ever had a capital call? Mysterious, anonymous attendee. No, we have never had a capital call. We've never paused distributions. So part of that is we're landing at such a low LTV that the banks look at the buildings that we're buying as very favorably, right? Typically, the buildings that we buy are going to appraise for 1 to 2 million more than we buy them for. The Kernersville property appraised for 1.9 more than we bought it for. That's not typical. It's usually closer to $1 million, but the buildings look at the bank. The banks look at the building. Excuse me. It's not that the building's not worth that. It's just that nobody wants a 90,000 square foot building, and then they know what we're going to do with it, and that we can control the cost. So because of that, we always are able to get fixed rate debt. The thing that has hung up so many operators over the last few years, and the reason so many capital calls have happened, is that bridge debt and variable rate debt shot up faster than it ever has in history. So we have never used variable rate debt. Sometimes we pay cash for our properties with our funds. Sometimes we will use financing, but always fixed rate debt. And right now we just got the latest debt that we got was 7% a couple of days ago, which we were very excited about. Previous to that, it was 7.75. We underwrite for 8.5%, but typically what we're getting is 25-year amortization. Underwriting for 8.5, but it's typically 7.75 to 7 on this last one. 5 to 7 year balloon, 25-year amortization, 65% loan to value. The 5 to 7 year balloon doesn't bother us because we know we're going to refinance at or before 5 years anyway. Always refinancing at a fixed rate long-term debt. So that's the reasons we've never had to have a capital call. And we're not going to leverage the properties too high. If the interest rates are low, we might refinance to as high as 60%. If the interest rates are higher, it might be 55 or 50%. Even there's going to be plenty of money to pay out the investors. It just might limit how much we pull out on the general partner side. But the important thing is we're protecting the asset first, so it's going to continue to cash flow, then protecting the investors, and then ourselves. All right, I think I've got one attendee with a hand raised. Let me go back over here. Oh, already answered that one. All right. Any other questions? I'm looking here. I don't think I have anyone else. Yep, everything's in order over here. So if anybody has any questions, I'd love to connect with you. I'm going to go ahead and go back to that last screen one more time, just so if you have an opportunity, if you need to schedule a call with us, you can use that QR code there. That will give you an opportunity to connect with us. There's my email as well as Neil's email as well. Feel free to reach out to us. You can call or text those numbers as well, and we're happy to connect. So listen, I really appreciate your time. Thank you so much. We're right at the hour, so I'll go ahead and cut it off here. But thank you very much for having interest in what we're doing. If it's not with us, I still think self-storage is a great opportunity. If you're going to do it, just in my opinion, storage these days needs to be safe, secure, well-lit, easy access, and it has to be climate controlled. So if that's something you're looking at doing yourself or with another operator, that's the direction I would look. So thank you so much. Appreciate your time. I hope everybody has a great evening.